Today I want to have a look at Ulta Beauty, ticker Ulta. So we will plug in the ticker ULTA and all the metrics will show up automatically in our stock valuation spreadsheets. Now this company was suggested to me by one of you guys in my previous Starbucks video, so if you want to go check that out, you can do so after this video. Now to get straight into the valuation, we can see that currently Ulta doesn't pay out any dividend whatsoever and that the current trading price of the company is sitting just below $400 per share, with the analysts predicting $542.83 by the end of the year, which is almost a $150 upside. Now, over the past year, the company is down by 21.71%, and we can actually plug that in here into the graph. We can plug in 164 days, and when we press enter, we can see that the company is actually down by quite a bit. Now, the beta of the company is sitting at 1.36, which means that the company is slightly more volatile than the S&P 500. Now, another thing with this company which I really like is that the institutional ownership is sitting at 96, almost 97%, which is a big green flag for me. Now, moving to the 9-pillar analysis, we can see that the PE ratio of the company is sitting at 32.88. That is the 5-year trailing PE ratio, which means that over the past 5 years, on average, the company has been trading at a premium. And the price to free cash flow is sitting at 21. Now these two metrics don't really bother me that much. Now looking at the other metrics, we can see that over the past 5 years the free cash flow has been growing at about 13% annually, as well as the revenue, and the net income has been growing by 84.54% annually. Now scrolling down to the financials, we can see that the net income has grown a lot indeed, growing from about $409 million to about $1,291,000,000 in 2023. Now we can also see that the company is buying back shares with about 4.31% decrease in shares outstanding every single year, which is great for any company. As we can see, in 2019 the shares were sitting at 58, almost 59 million, and in 2023 they were sitting at 49 million, and currently they are sitting at 48 million, which really means that the company is buying back shares as they are trading low, and that is a great sign for any company. Now we can also see that their long-term liabilities over the 5-year free cash flow negative dividends, they don't currently pay out any dividends, but the long-term liabilities over the 5-year free cash flow is sitting at 0.39, which is great, which means that they can essentially pay off any long-term liabilities in about 3 years, which is great. So now we can move to the first valuation model, which is the Graham's formula. And here we take the trailing earnings per share, the base PE, the 5-year growth estimate, the growth rate multiplier, the average yield on AA Corporation bonds, and the current yield on AA Corporation bonds, and get an intrinsic value of $525.93, about a quarter or 24% higher than the current trading price. Now moving to the next valuation model, the discounted cash flow valuation model, we plug in the free cash flow over the past 10 years and calculate the average growth rate to be sitting at 41.52%. Now for the next 5 years, analysts project a growth rate of 6.5%, and I would calculate a growth rate of about 9% per year for the next 10 years. And using this, I'll calculate the future free cash flow up till the year 2032, including the terminal value. Now to calculate the present value of that future free cash flow, we need our discount rate, and to get our discount rate, we have to look at the company as a whole and really understand what percentage of return we want from that company. If the company is more high risk, we essentially want a higher return. So I will plug in a discount rate of about 9%, and using that I will calculate the present value of that future free cash flow I just calculated. And then I sum up all that future free cash flow, add cash and cash equivalents, subtract total debt, and get an equity value. Now I divide that by the shares outstanding and get an intrinsic value of $495.86, about $100 higher than the current trading price, or about 25%, very similar to our Graham's formula. Now moving to the multiples valuation, I will be comparing Ulta to BBWI and DKS, companies that trade in the same sector. and we take these companies' stock prices, divide by their earnings per share, and get their PE ratios. We then average out these PE ratios and multiply by the earnings per share of Ulta to get an intrinsic value of $378.33, which is slightly lower than the current trading price by about $20. Now we will skip our dividend discount model as the company currently doesn't pay out any dividends, and we will arrive to our ultimate intrinsic value, which will give us an ultimate intrinsic value of $466.71, about 16.81% higher than the current trading price of the company. Now, if we plug in a margin of safety of 15%, that would be a hold at the current trading price of the company. But if we plug in a margin of safety of 10%, we would get an acceptable buy price at $420.04. Now, don't go out and buy this company just based on this evaluation. You have to do your own research in the back end and make that decision on your own rather than listen to me telling you that you should buy or not buy a company. Now, if you find these spreadsheets helpful and want to evaluate any company on your own, you can download them at my Patreon in the link in the description. And by doing that, you will also support me and let me know that you enjoy the content. With that, if you enjoyed the video, let me know down in the comments which company you'd like me to evaluate next, and make sure to leave a like and subscribe.